It is a common misconception that the numbers displayed on your phone screen or within a banking application are actually money. Seeing those digits increase brings a sense of security, and there is a belief that this is an inviolable asset, the result of your hard work carefully stored in a fortified digital vault. But the reality is much harsher. That is not money. That is information. It is a promise to pay from the bank to the account holder. When you hold a physical banknote in your hand, your ownership is absolute. No one can remotely deactivate that bill, and no one can prevent you from handing it to someone else in exchange for a loaf of bread or a shirt. Power lies entirely in the hands of the physical holder. However, once that money is deposited into an account, the nature of ownership changes completely. From direct ownership, this right shifts to a state of conditional ownership. Or more accurately, it is a right to demand payment. At this point, the depositor becomes a creditor, and the bank becomes the debtor. The relationship is subtly inverted in a way that few realize. Money in an account is essentially a debt entry by the bank toward the customer. And because it resides on a third-party system, it must follow the rules of that third party. If the system says no, that asset is immediately frozen. If the algorithm is suspicious, access is revoked. This is the fragility of digital assets in an era where everything is identified and controlled through lines of code. We must examine the operating mechanisms of the modern financial system more deeply to see the trap of convenience. The shift from cash to digital currency, the so-called cashless society, is hailed with flowery words like modern, fast, and transparent. It is indeed fast. It is indeed convenient. But the price to be paid is the right of self-determination. In a physical environment, a transaction is between two people, the buyer and the seller. In a digital environment, there is always a third party standing in between. That is the bank, the e-wallet, or the payment gateway. This third party does not just perform the task of transferring money. They perform the tasks of surveillance, authorization, and record-keeping. Every transaction performed must pass through the filters of the intermediary system. Usually, this filter operates so smoothly that users forget its existence, but with just one technical command, a policy change, or a suspicion from a security algorithm, the valve will be locked. Imagine a simple scenario where you sell a high-value item and receive an unusually large sum of money into your account. Immediately, the anti-money laundering algorithm is triggered. The account is temporarily locked for verification. This process can last days, weeks, or even months. During that time, the money still appears on the screen, but it cannot be used. It is there, but it is not yours. That is when the concept of conditional ownership reveals its true form. The conditions here involve proving the source, explaining the purpose, and most importantly, being permitted by the system. Another common mistake is the belief in the absolute fairness of technology and the assumption that machines are unbiased. But machines are programmed by humans and operate based on risk management rules. For financial institutions, the safety of the system is more important than the inconvenience of an individual. They would rather lock by mistake than miss a threat. When an account is flagged, the burden of proof regarding innocence lies with the account holder. You must scramble, submit documents, and wait. Meanwhile, cash flow, which is the lifeblood of business and daily life, is stagnated. If it is idle savings, it might just be annoying. But if it is working capital, payroll for employees, or urgent medical fees, this technical freeze can lead to the collapse of an entire career or even a life. It does not stop at bank deposits. Look broadly at other types of digital assets that are making up an increasing proportion of modern human wealth. YouTube channels, social media pages, and seller accounts on e-commerce platforms are all money-printing machines and real assets that generate cash flow. Many people spend their entire youth building a media channel with millions of followers, considering it a lifelong career. But the legal nature of owning such a channel is extremely flimsy. In reality, content creators do not own those channels. They are merely being granted the right to use the platform of a technology corporation. When reading the terms of service carefully, those long documents that most people skip and click agree, one will find cold lines declaring the supreme power of the provider. They have the right to unilaterally terminate accounts, delete content, or change revenue-sharing mechanisms at any time without prior notice, or even without providing a specific reason. Just one violation report from the community, whether true or false, can allow the automated system to wipe out years of effort in an instant. At that moment, digital assets evaporate as if they never existed. There is no court to sue effectively because the rules of the game were signed from the start. It is their playground and their rules. The core difference between physical assets and digital assets lies in independence. A piece of land, a house, or a gold bar are physical assets. Even if the government changes, the bank collapses, or the internet is cut, the land remains there and the gold remains in the vault. Physical control provides a final layer of protection. To seize a physical asset requires brute intervention, which is costly in terms of resources and time. Conversely, digital assets depend entirely on technical infrastructure and the maintenance of the managing entity. If the server crashes, if the data is corrupted, or if the company goes bankrupt, digital assets risk returning to zero. Furthermore, in the digital age, data is the shackle. Every spending behavior and every source of income is tracked. This transparency is good for management and crime prevention, but it is a double-edged sword for individual freedom. When cash is completely eliminated, humans lose the right to financial anonymity. Every transaction, even the smallest like buying a pack of candy, is recorded. This data is used for credit scoring, behavior analysis, and in worse scenarios, social control. If an individual is assessed by the system as a risk or fails to comply with certain standards, their financial access can be limited immediately. No plane tickets, no hotel rentals, and no loans. Citizenship at this point is tightly bound to a score on a financial system. We must face the truth that money in a bank account does not sit still in one place. Banks do not put money in a warehouse. They use that money to invest, lend, and rotate capital to generate profit. The balance displayed on the app is merely an accounting figure. In the event of a crisis of confidence, when everyone wants to withdraw cash at the same time, the bank will not have enough cash to pay everyone immediately. At this point, administrative measures will be applied, such as limits on daily withdrawals, requirements for prior registration, or temporary suspension of transactions. Once again, the owner's right is placed behind the safety of the system. It is your money, but you cannot take it out when you need it most. So is it truly yours? Looking at geopolitical risks, in a volatile world, economic sanctions have become common weapons. An individual or an organization can be blacklisted simply because of their nationality, business relationships, or complex political reasons. When sanctions are issued, international payment systems like SWIFT, Visa, and MasterCard will immediately disconnect. Assets held abroad, international stocks, and bonds can be frozen indefinitely. Real-world examples in recent years have proven that nothing is absolutely neutral in the financial world. The ownership of cross-border digital assets is more fragile than ever in the face of political decisions. So, what should be done in the face of this reality? Rejecting technology and returning to the Stone Age is unthinkable and foolish. The convenience and speed of digital finance are indispensable levers for economic development. The issue is not a boycott, but understanding the rules of the game so as not to become a victim. One must clearly define a mindset to never put all your eggs in one basket, especially a digital basket where someone else holds the handle. True diversification is not just buying many stocks or depositing in many banks. Real diversification must be a combination of asset types with different legal and physical natures. It is necessary to maintain a certain percentage of assets in physical form, meaning things that can be held, hidden, and controlled directly without going through the internet or any intermediary organization. Physical gold, real estate with clear legal titles, or even a reserve of cash sufficient for short-term living when the system fails are necessary shields. These assets act as the final bulwark, ensuring survival when the digital world is disconnected. For digital assets, it is necessary to understand the operating mechanisms of cash flow to avoid getting caught in risk control algorithms. Splitting cash flow and using multiple accounts across different banking systems is a logical tactic to minimize the risk of a total freeze. If doing business based on third-party platforms, like social networks, or e-commerce sites, building your own customer database and owning your own website is a survival step. Do not build castles on sand, and do not let your career depend entirely on the nod of a tech giant. Knowledge of the law, especially regulations on anti-money laundering and tax declarations, is the strongest protective shield. Proactive transparency will help avoid unnecessary trouble with censorship systems. When the cash flow is clean and has a clear origin, the risk of being frozen is significantly reduced. However, even when everything is done correctly, technical risks always exist. Hackers, software bugs, and connection failures are unpredictable variables. Therefore, backing up financial data and keeping important transaction records is a mandatory habit for a wise asset manager. Finally, we need to change our perception of wealth. Wealth is not just the total asset figure on a balance sheet. True wealth includes the ability to access and control those assets in all situations. A billionaire on paper who cannot withdraw money to buy food when the system crashes is, in that moment, as poor as anyone else. Power lies in liquidity and the right of control. In the digital age, financial freedom is not just about how much money you earn, but how much right of self-determination you maintain over that money. In summary, the money in your account is yours nominally, but the right to use it depends on the system's permission. That is a cold but necessary truth to accept. Do not let convenience lull you to sleep. Utilize technology to get rich, but use a pragmatic mindset to protect the results. The balance between digital and real assets, between convenience and control, is the key to ensuring solid financial security in a world that is becoming increasingly virtual and unpredictable. Do not wait until your account is locked to realize who is truly holding the handle.